What's up guys, Adrian here. Welcome to my channel on passive income investing. So a couple of weeks ago I released a video about how to invest in the big six Canadian banks. So when it comes to financial stocks or the financial sector as a whole, many people automatically think of banks. So there is a segment, however, of the financial sector that doesn't get the same amount of attention and notoriety as the banks. These companies usually fly under the radar. So yes, I'm talking about life insurance companies, or simply Lifecos. So the reality is that these companies are old, they're big, and they're lucrative, just like the big banks. In addition, they tend to be fairly stable because much of their revenue comes from insurance premiums, which are long-term and stable contracts. When it comes to Canada, there are three big players that dominate the entire industry. If you're Canadian, I'm sure you heard about them. Number one is Manulife, number two is Sunlife, and number three is Great-West Lifeco, which recently consolidated their brands under one name, Canada Life. Great-West Life, by the way, is owned primarily by the Power Corporation of Canada, a huge Canadian asset management company which also owns Investors Group and Wealthsimple. So what about the US? Well, some big players include Metlife, which has that iconic New York City building you've probably seen in a bunch of movies, as well as some names like Lincoln National and Prudential Financial. A couple of others as well. Right, so how do these companies make so much money? Well, it's no surprise that life insurance products are their bread and butter, but don't think that's their only source of revenue. I did some research on this, and these are some of the insurance products these companies offer. You have life insurance, of course, then there's health insurance, travel insurance, but they also have things like critical illness insurance, long-term care insurance, disability insurance, mortgage protection insurance, business owner insurance, and I'm sure there's others that I missed. Also, don't think that these companies only offer insurance products. They also manage group and retirement benefits for other corporations. For example, I work at Air Canada, and Manulife handles our retirement benefits, which means you're obligated to buy into Manulife-owned mutual funds. So in addition to those insurance products, they also offer investment services to individuals and businesses, which means they're basically also asset and wealth management companies. In addition, selling insurance isn't restricted only to North America. Manulife and Sunlife, for example, have growing revenues from Asian markets. So I think you get my point by now. These are not mom and pop companies we're talking about here. If you actually look at how long they've been in business, you realize that they can be just as old as banks. Manulife, for example, 1887, Sun Life 1865, Great-West Life 1847, Metlife 1868, etc., etc. So they've been in the game a really long time. They know exactly how to price their insurance policies because of all the research and data they've accumulated over the years, which simply means they will always be profitable. Think of them a bit like a casino. Yes, there will always be a lucky one-time winner, but all that money people lose will always balance out the rare winners. Hence the famous expression, the house always wins. So I don't want to ramble on too much on how these companies make money, but I do want to make one last point. These companies need to have a lot of cash on hand to pay out insurance policies, right? Well, what do you think they do with all that cash on hand? Leave it in the bank making 0.1% interest? I don't think so. They invest it to make even more money. With all the data scientists and financial experts they have on their staff, they know exactly what they're doing in terms of investing. Some of their investing profits do go to lowering premiums or giving out some small dividends to life insurance policy holders, but rest assured, a lot of it just goes to the bottom line. So what kind of dividends do these companies offer us passive income investors? Well, let's check out the current dividend yields and the 5-year dividend history of Manulife and Sunlife, just so you could see or get a quick idea of what kind of dividends you'll be getting and if it's a good investment or not. Alright, so looking at Manulife, the biggest player in Canada, right now the stock price is at $19. And as you can see from the 52-week range of $12.58 to $27.78, there's still a lot of catching up to do. That's why I think these stocks are very discounted right now. If we look at Manulife's dividend yield, right now it's 5.89%, so really, really good. And even more impressive is the dividend history. So if we look at the 5-year history, you could see in mid 2015 the annual dividend was 68 cents per share, and throughout the years, as you could see here, as we go down, it just keeps getting increased and increased, and right now it's at $1.12. So really nice increases here for Manulife. If we look at Sunlife, it's a bit of the same story. The stock price right now is 53.26. If we look at the 52-week range, 35 to 66, you could see that there is still room for improvement. That's why I think Sunlife is also very discounted right now. The dividend yield is a bit lower at 4.13%, but if we look at the dividend history, it's just as impressive as Manulife. So if you go here back to 2015 at $1.52 per share, throughout the years, just like Manulife, they keep increasing it over and over, and right now it's at $2.20. So really significant dividend increases for both companies in the last 5 years. So the average dividend yield right now, if you invested, let's say, in the big 3 Canadian Lifecos evenly, is a little under 6%. Not bad, considering that they consistently increase their dividends like we just saw. And also note that all 3 companies are discounted right now, as they have not really fully recovered from the COVID market crash, making their dividend yields a lot higher than normal. So yes, investing in the stocks individually, just like investing in the stocks of individual big banks, can be a good choice for the long term. But is there a more efficient way to invest in these Lifecos? Is there a way to lower your risk and diversify better by getting a piece of not only the Canadian ones, but the US giants as well? Is there a way to invest without having to pick and choose individual stocks? That could be long, tedious and stressful, especially for amateur investors or investors who simply don't have the time or simply don't care. Lastly, and more importantly, is there a way to get more income than owning the stocks individually? So the answer is yes to all of those questions, and once again, an ETF is the answer. So after looking around, I found an amazing ETF from CI First Asset that not only includes the top life insurance companies in Canada, but also in the US, and right now it's giving an 11% dividend. So don't believe me? Let's go check it out. So this is the ETF, guys. It's the CI First Asset US and Canada Lifeco Income ETF. The stock symbol on the TSX is FLI. So as you can see here in the description, it invests in the 10 largest US and Canadian life insurance companies by market cap. So you're getting the 10 biggest in North America. If we quickly look at the holdings, you have the 10 companies here. So from Canada, of course, you have the big 3. You have Sunlife, Great-West Life, and Manulife. And the others, so the other 7 are from the US. So of course, you have Metlife here and the other big players like Prudential and Lincoln. So really the best of the best, or the biggest when it comes to life insurance companies here. Now for the best part, the dividends or the distribution. So if you look at the distributions here, you could see that the 12-month trailing distribution yield, which simply means the average distribution yield for the last year, is a whopping 11.28% right now. So that's really, really great. It will beat owning the individual stocks easily. So we have the breakdown here. This ETF was created at the end of 2013. So if we look at the dividends per year, you could see that they do vary. Keep in mind that this ETF, or actually all covered call ETFs from CI First Asset, number one, they give their dividends quarterly, so every 3 months, and they can vary. But if we look at from 2016, you could see 70 cents, 67 cents, 72, 70. They're fairly stable. Where there was a big jump, it was actually in 2020. So usually, let's just look at 2019, for example. You could see the dividends here, the breakdown. So it's about, you have 19 cents here, 15 cents, 16 cents, 18 cents. So on average, it's 70 cents. But in 2020, you could see here the first dividend at the end of March was 18 cents, so it looks pretty normal. But there was a huge jump in the latest dividend. It was 33 cents. So this actually makes sense. This is because of the covered calls. This is the power of the covered calls. So what happens is that when there's a lot of volatility in the stock market, the price for options goes up, which means that if you have a covered call ETF where a lot of the the revenue comes from selling covered calls, you actually make more money. And that's why you could see here that there was a nice jump in a dividend for the quarter. So 11%, yes, it will vary. It might not always be 11%. It could be more, it could be less, but rest assured, it's going to be much higher than owning the stocks individually. So a really, really good no nonsense stock here. You have one stock, you have all the companies, all the top life insurance companies with only one stock. So really, really simple and efficient way here of owning life insurance companies and getting a lot of income in the process. So that's it, guys. The FLI ETF is, in my opinion, the best way to invest in the top life insurance companies in North America. They don't get the attention they deserve, in my opinion, for such old and lucrative financial institutions that really have a foolproof business model. Really a no-brainer investment, if you ask me. Also, add the massive dividends you're getting from the dividends of the stocks and the covered call premiums, and you got yourself a great income investment, giving you cash every 3 months or every quarter for the rest of your life. So thanks for watching, guys. I really appreciate it. If you learned something, hit the like button and make sure you're subscribed so you don't miss out on my future content. So take care, guys. See you next time.